A home equity reverse mortgage, or what we call a HECM, is a Federal Housing Authority insured reverse mortgage issued by the Department of Housing and Urban Development through approved lenders nationwide. It is intended for borrowers who are age 62 years or older. Their unique features make the HECM a valuable tool in retirement planning and aging in place. It can be difficult to understand the mechanics of a HECM, and this video will educate you on how much you might expect from a HECM given the age of the youngest borrower or non-borrowing spouse, and the value of your home. So let's look at how we calculate your gross loan amount, or what HUD calls your principal limit. The principal limit factor is the primary assumption here. It is the percentage of your appraised value that will be your gross loan amount. This factor is based on your age, the youngest borrower, and our estimate of that person's remaining life, along with the FHA expected or qualifying rate, which we provide to FHA. The FHA provides the factor. In this example, at age 72, you could get a gross loan of 58% of the appraised value, subject, of course, to the maximum appraisal under the program of $636,150. You will notice that as the age increases, the principal limit factor also increases. This principal limit factor is the percentage that you will borrow of your home value. Basically, the older you are, the shorter your remaining life. The shorter your remaining life, the less interest and mortgage insurance reserve we need to reserve for. A smaller reserve means that you will have more money available to borrow. If you look at the second half of this chart, where the FHA expected rates, remember this is not your mortgage rate but the qualifying rate, are increasing by 1% over the same age range, you will notice that there is a substantial drop in the principal limit factor. This is because more needs to be reserved to cover possible future costs, so you get less. Rising interest rates are not friendly to HECMs if borrowers wish to take down a large portion of the proceeds immediately or in the future. Let's get a bit more specific. Note the assumptions we're using and that the maximum appraised value of $636,150 applies to the program. Also note that if there's a non-borrowing spouse, we are required to take their age into account. If they are younger than the spouse on title, we must use that age to do our calculations. And a non-borrowing spouse can be younger than 62. However, all borrowing parties on the title must be at least 62 years of age. So as noted previously, we take the youngest borrower or the youngest non-borrowing spouse. We figure out their estimated age at debt based on annuity tables. And from this information, we know their remaining life. And we calculate how much of the appraised value is remaining if we reserve all the interest and insurance, assuming they took all the money immediately, never made a payment, but we do include some modest home appreciation of 1 to 2% over the period. So interestingly enough, in a HECM, you do get credit for future property appreciation. And we apply that factor to the appraised value, and you can see the amounts are calculated here. Let's take a real example. Assume a $400,000 appraisal with a 62-year-old borrower and the FHA minimum expected rate or qualifying rate. That appraisal is essentially divided between what the borrower could take out immediately and what we need to reserve for interest and insurance on the loan based on the inputs we discussed on the previous slide. In this example, $204,000 is available, and $196,000 is reserved for unpaid mortgage insurance premium and interest. But if the portion is unused, the line of credit will grow annually at the rate of interest and the insurance cost. So what happens if this loan is not used for 5 years? Well, the available amount under the line of credit would grow to $269,000 because $66,000 of interest and mortgage insurance reserve was no longer required. If the line was unused for a long time, it could exceed the original appraised value and could also exceed the then current market value of the home. Under the program, even if we know there is a deficit, even if we know the line of credit exceeds the then current market value, the borrower can still draw 100% of the available amount. In this way, a HECM can actually be a hedge against declining real estate values. If you want to learn more about reverse mortgages, go to Amazon.com and find the ebook Reverse Mortgages for Retirement. It's got about 130 questions and answers on the most important aspects of reverse mortgages. Or if you like, reach out to me and I'll send you a copy. I also recommend you go to our website, jmcapitalreverse.com. It's loaded with information for both professionals and for consumers. Finally, if you think I can help you, reach out to me at my email or call me on my cell phone. I'd be delighted to answer any questions you have. I hope you have found this video helpful.